Hi, my name is Brenna Bauckham, and I am a certified financial planner with the H Group. We are a wealth management and financial planning firm here in Salem, Oregon. And over the past few weeks, I have been having some conversations with Marilyn and Deirdre and the Capital Manor board about any opportunities we might be able to provide to the residents to help give them some financial perspective on the recent uncertainty that we're all experiencing. And given the CDC recommendations of social distancing, I'm afraid this video conference is the best we can offer at this time. So it is my goal today to run through 10 questions that I believe to be on the minds of a lot of our client families, and certainly many of whom are there at Capital Manor and who I've spoken to. And hopefully they'll answer some questions you have too. So by way of background, I am a CFP, as I mentioned, and I spend my days earning the trust of my clients, to put it succinctly. I am very privileged to be brought into some of the most private and important parts of their lives. And it's always my goal to bring clarity to the unclear, which is certainly, there's a lot of there's a lack of clarity here today in the certain situation we're in. So hopefully I'm successful in my aim. So let's get started. The first question you probably have on your mind, or may have on your mind, is what does this stock market volatility mean for my investments? So you have probably been watching the news and hearing that the S&P 500 is down 20%. And what does that mean for you in particular? And the answer is it depends. So your allocation, your asset allocation, and the diversification within your portfolio will determine how much of a hit that the most recent pullback may be having. So what those terms mean in plain English is how much of your pie chart is exposed to the stock market. And in most cases, within our firm, we're strong believers of asset allocation and diversification, which means we're going to have some exposed to US stocks, some to international, some to medium-sized companies, small-sized companies, some to fixed income or bonds, some to government bonds, corporate bonds. So it diversifies within each area and each sector. So if you are working with an investment advisor, that may very well be true for you. So when you're hearing the stock market is down 20%, that might not be the case for your portfolio. The other thing I'm trying to remind our client families about is there are other income streams that are not subject to this rocky road that we're currently on. So many of you have worked a long time, very hard, for pensions and Social Security income, which is a steady stream and is not subject to the ups and downs. So it's a good thing sometimes if you're feeling a little insecure and uncertain to focus on the positives like that. Question number 2, should I move my money out of the stock market and into cash? The answer to that, maybe, but probably not. So exposure to stock, and the reason we have it in our portfolios, is to keep up with inflation. It's the growth aspect of your portfolio. And if we were to take some money out of the stock portion of your portfolio and move it into cash at this moment, we would be doing the opposite of what we try to encourage investors to do, which is to sell high and buy low. You would be instead selling low at this market pullback, and maybe later you would say, okay, I feel better, and you'd be ready to buy in, but likely that would be when the market's on its way back up in this recovery phase. So to move money out of the stock market and into cash at this moment would lock in your losses, most certainly. And actually, I have an interesting graph I want to share with you on this. And what this is the Dow Jones Industrial Average over the last few months. So the red lines are all days that the market did poorly and was in the negative, and the black lines are when it did well. And without this gift of hindsight, seeing these numbers on the screen in this chart, which days would you have guessed may have been best to buy or sell? It would have been very, very difficult. So this is the folly of trying to time the market, as you never know what the next day is going to hold. I have another graph I want to share with you. This shows a hypothetical $10,000 investment straight into all S&P 500 stock assets from 2004 to 2019. And if you were to have stayed fully invested that whole time, you would have had a 9% annualized return, and your $10,000 would have turned into $36,418. If, however, 2008 or 9 had you worried and you decided, well, I'm going to get out of the market, I can't handle it anymore, you most certainly would have ended up with less money. And so this gives you an idea. If you missed just the best 10 days of that time frame, your return would have dropped down to 4%. Best 20 days down to just a little over 1%, and so on and so forth. So this has been a big part of the conversations we're having with our client families to remind them of the detriment of making changes into cash during this time. So if you're feeling like that's what you might need to do to feel comfortable, I highly encourage a phone call with your advisor. So next question, do I need to stop spending money? Maybe. I'm sorry for all of these vague answers, but that's how financial planning is when you're giving generalized advice, or at least how it should be. So maybe, but the one thing that times like these do offer is an opportunity to just reflect on spending habits. And spending can do a couple of things for us, right? It can fulfill these short-term kind of fleeting fun things, and it can also support our core values. And we want to make sure we continue to support who we are through our spending habits, but maybe cut back and make some temporary shifts on the other side of things to protect that long-term security. And there at Capital Manor, of course, you have the foundation, which is there as a backup. So if you're really worried and stressed out at nighttime, I hope knowing that that's there for you brings a little bit of comfort. Question number 4, what about the legacy I was hoping to leave? And so legacy means a lot of different things to a lot of different people. It could be an inheritance, it could be some charitable intent or some combination. And really, it's best to formulate legacy plans when the markets are calm and with a trusted estate planning attorney and a CFP professional to help as a liaison. And really, you shouldn't be making changes to your legacy plan because of market movement. You might want to call if it's been a few years just to check in and see if anything has changed. But markets are cyclical, and inheritors and benefactors are going to be grateful regardless. So I wouldn't let that be a reason for you to think that you need to make major changes. But again, if it's been some time, you might want to check in just as things do change. So question number 5, how can I stop worrying? And this is arguably the question that underlines all other questions that we've gotten from our client families over this time. And my advice is always to be kind to yourself. So we're in a really unusual time, right? There's a pandemic, financial assets are falling, we have an uncertain economy, we have this 24-hour news cycle of noise, and we have this inability to connect with the people that we care about in the ways that we traditionally do. And this brings about this acute, stressful environment that really inhibits us from being able to step back, get some perspective, and sit with our thoughts. And really, in order to keep yourself healthy, first and foremost, but then keep yourself from taking any action that might really derail your long-term security and your long-term plan, you have to find a way to manage that stress. And so here are some of the things we're working on with our client families. We're saying, first focus on the positives. So focus on all of the things we have going for us. We talked about income streams earlier. Talk about those things that are not exposed to the market and the portfolio shifts and planning that we've done to prepare for this event. None of us could have guessed that the coronavirus was going to be the catalyst for this pullback, but we all did know after a long bull market that something was going to come. And so we've been making some shifts over the last 12 to 18 months in our clients' portfolios to prepare for that. Next, ward off stress in the ways that that work for you. So if you enjoy reading a book, going for walks, knitting, whatever it is, make sure you're doing those things and making those things a priority. And then create shared experiences however you can. So if you can still have 6-foot conversations there at the manor, encourage you to do that. Phone calls, of course, with family and friends. And if there's a way for you to connect with those that can't visit, if there's a way for you to connect with video, I highly encourage it. There's something very special about being able to see your family member's face. So, and then I have just a quick graphic I want to share with you on what this has looked like when we've been through it before. So here's world epidemics, and this blue line is the MSCI World Index, which is a combination of the markets. And so we have various pullbacks. You see these big jagged, mountains falling down. Here's this big one here is the .com bubble, and here's the financial crisis. So in those times, we experienced SARS, we experienced the swine flu coming up and down. We have Ebola, we have Zika, these various things along the way. And I show this to you to remind you that we have been through epidemics before, and it's always been unpleasant, but we have gotten through them, and we will get through this one too. Sometimes that's easier to remember than others, for sure. Question number 6, if I haven't heard from my financial advisor, should I call them? And my answer to that would be, if you are scared and worried, then yes, absolutely. That is why we are here. And they can get specific on your situation and answer the question of, okay, I'm hearing all this news about the stock market crashing. What's my portfolio doing? So they can get you some specifics. I have another good, well, I think it's good. I like these graphics, and I hope you do too. Here's another one. The orange line is your S&P 500, or the stocks you're hearing about going down. And this first column that we're looking at here is year to date. So it's January to March 27th, so last Friday are these numbers. The S&P 500 down about 21%. Here's a representation of bonds, is this middle brownish color. It's up about 2.6%, so a good sign of why we should have some mix of different eggs in our basket. This tannish color is a mix of what we call a balanced, generalized balanced portfolio, which says about 60% of your portfolio is in stocks, 40% in bonds, and that may be more or less aggressive than what you have in yours. It's just kind of a general idea of what a blended portfolio might look like. So you'll see that blended portfolio is down about 12%. It's still not fun and it's not pretty, but it's not the negative 21% we're seeing when we're all in the stock market and what we're hearing about in the news. Next column over is year to date. So, is the 1 year. So from March of 2019 to this March. So S&P down about 7.5%, bonds up a little over 8%, and the blended down just a percentage point. So 12 months. And this kind of backing out and trying to get perspective on the longer term is what we're always encouraging our client families to do. So this next column is even further back. It's a 5-year average. So S&P 500 up almost 6.5%, bonds about 3.2, and then a blend of that almost 5.5%. So you can see how these numbers are pretty darn different depending on how your assets are allocated. So again, really helps to make sure you're asking the right questions. And that brings me to my 7th question out of 10 here. And what are those questions I should ask my advisor? Okay, if I should call them, if I'm scared, what should I talk to them about? So any of the questions that we've been talking about here today would be fine. If they resonate with you, you can ask them of your advisor and see what they have to say. Other questions you might consider: what are the changes that you're suggesting or making to my accounts during this time? Can we update my financial plan and assure everything is still on track? The market pull. I'm always a firm believer in the power of a financial plan, but during market pullbacks can be such a great time to have something nice and unbiased and unemotional to look to and cross-reference and say, how are we really doing? Are these things are factored into my long-term plan? Is it still on track? Am I still in good shape? Are there any changes I need to be making to my withdrawal habits? Would be another good question. And finally, how does the CARES Act impact my required distribution in terms of my overall financial plan? And that's an excellent segue into my 8th question, which is, what do I need to know about that recently passed CARES Act? So if you're unfamiliar with it, on Friday, the CARES Act was passed, and it is a support mainly for businesses, small businesses that are struggling during this difficult time. And what you probably have heard most about is that there is a $1,200 check coming out to support individuals. And there are, of course, provisions. Anything that comes out of legislation is packed full of provisions. So I'm going to give you just a real brief overview of what you might have heard of. So it's $1,200 for a single individual who has a taxable income of less than $75,000 a year, or a $2,400 tax credit for individuals who are married filing jointly with taxable income under $150,000 a year. And so there are some of you that may receive it and some of you may not. And I've heard from a couple of you who will and who feel conflicted about that, who feel like maybe there's others out there who may need it. And what should you do with it? What's the best use of it? And as I think of this with every bit of money, every dollar we have should go to support what we find important, what our core values are. That might be earmarking it for the Capital Manor Tip Fund. It might be earmarking it for the foundation or for a nonprofit that you know that does good work in Salem or internationally, or the fight against coronavirus. There are a lot of needy opportunities out there and organizations who would love to have your support. That aside, a provision within the CARES Act that is more likely to impact you is what I referenced in the last question. And that is your required distribution. So if you have an IRA account, you have been taking required minimum distributions or will since you were in your early 70s. And this CARES Act includes a provision that allows you to skip your required distribution for this year only. And the thought process behind that is that your required distribution is based on the December 31st value. And at this point, the value of your portfolio is likely pretty different than it was on December 31st. And so you would be taxed on income that really is no longer there, or on assets that are no longer there. And so if your cash flow allows it, it would be a good idea to talk to your advisor and say, is it worthwhile for me to skip taking my required distribution for this year? Again, some of you need that money month to month, which is what you saved it for. That's what you should be using it for. Others, if you have some flexibility, you might talk to your advisor about your choices and your options. Question 9, speaking of required minimum distributions, when do I have to start taking money from my IRA? And so if the CARES Act wasn't enough for you in legislation, the Secure Act was an act that passed at the end of December, and it changed the required minimum distribution age from 70 and a half to 72. And so those of you who are turning 70 and a half or older after January 1st of this year, 2020, you will not have to take your required distribution until you turn 72. Again, there is that exception right now for 2020 based on the CARES Act to skip it. So there's also a couple provisions in there about beneficiary designations and retirement trusts that change. And so if I say the term retirement trust and that brings up a flag of a memory for you of what you might have as a beneficiary of your IRA, call your estate planning attorney because there may be some updates you need to do to your beneficiary designations. So enough of that legislation stuff. So the final question I wanted to share with you, or that I actually have heard this one from one of my client families who lives there at the manor. And she said, my family member was recently laid off. What's going to happen to them? And that's a hard question to answer, of course, but the length of the pullback will definitely impact the length of the recovery. right? Because this is all kind of happening in sections, subsections, cities and states and countries, and then the recovery is going to happen just as sectional, right? This pent-up demand that we all are feeling as we are doing our social distancing might be building, but at the same time, those people who are out of work are going to be spending down any savings they may have had, especially if they were laid off or in one of the employment sectors that was heavily hit by this. And I have another interesting graph, you'll be surprised. So this talks about some of the areas that were hardest hit, and what is expected through next month, through April. So hospitals and outpatient care, unsurprisingly, are still they're overrun. I'm not sure doing well is an appropriate phrase, but hospitality was certainly hit the hardest. In some areas, it was down over 60%. And all of these areas, you'll see all of these negatives. Only 29% of workers can work remotely, and that makes it a real challenge for some of these industries to keep their staff. So unemployment claims are way up, as you would expect them to be. But there is some reason to be hopeful. So these graphs are all provided by economists, and the Wall Street Journal are where these two in particular came from. And some of them are predicting that next quarter is going to be rough, a pretty deep contraction, and we may actually be headed for a technical recession. But it is projected that it will be short-lived. So earlier in the year, January through February, the economic numbers were sound. The banking system was fundamentally sound, unlike in 2008. And this data and the economists are projecting that we may have positive quarters for 3 and 4 through the end of the year. So we will see. That it's all projections at this point, which is always a challenge to feel real good about. So that's what I had for you, and I know you have been a captive audience, so I appreciate your attention, and I hope that you will send me your questions either through email or give me a call if you want to. And like I said, if we have enough commonalities between the questions that are being asked, maybe we can do this again sometime if it's useful, if it feels good. I'm happy to help however I can and do our best to keep you informed. So just thank you so much for tuning in today, and we look forward to seeing you next time. Thanks.